Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as StockCharts.com. So today I want to cover off the current situation in the market and what makes down markets hard. They're very hard to trade, and so it's important that people have a plan. And we're gonna talk specifically about how to get a plan, some things that we're looking for, and it's difficult to have conviction either way, and the reason is because we're just starting to test the 200-day moving averages on these indexes, and as we get down there, the breadth is very weak, so it looks to me like it wants to break a lot lower, but each week it seems like on a Monday we get a big directional move one way, and then the next day it's actually going the other way. So and the rest of the week kind of runs on. So we're going to see if that's the case. Now that we didn't have a trading day on Monday, we're on Tuesday going into Wednesday, but we've also got options expiration in 3 or 4 days. We've got the Fed meeting a week out. So we've got lots of things to put up with, as well as earnings coming in regularly. And you saw Goldman Sachs made a miss and they were hit hard. JP Morgan made a miss and they were hit hard. So very surprising to see probably some of those names actually take a hit. And then we've got the merger and acquisition stuff with Microsoft buying Activision, a gaming company with a market cap in the, 65 or 70 billion dollars, I think is the buyout price. So that's just huge. Canada's largest oil company, I think, has a market cap just 80 billion. So we value gaming as much as energy, I think, is the way that plays out. Anyway, it's difficult to have conviction here. The commodity space has worked well, but even today we're sitting with crude oil testing its prior highs around $85. And, when somebody says testing the prior highs, what does that mean? That means that the previous level was there, and for some reason the market stalled there now. In a series of higher highs and higher lows, eventually the market can work its way higher. I still think this crude oil market plays out a lot higher. But again, 100 million barrels a day, so each dollar in crude oil, not just for the oil exploration companies and whatever, but for everybody worldwide, that's a big deal, because that dollar, as crude oil goes up, we end up pushing up the cost of goods sold, which create inflation. We make it harder for people to get to work. If they don't get paid enough, then the cost of getting to work ends up being more than the cost of the benefit of being at work and having some left over. So there's a whole bunch of confusing issues that play out, but energy is a really important thing. I still think that we have a lot of political positioning around clean energy without a strategy to get to clean energy in a reasonable, I'll call it organized way. And my big complaint on that is that we don't force the utility companies to at least have a 10% buffer or a 5% buffer over their highest day. And the problem that's creating, I think New England is paying almost 10 times what they were paying in 2019 and 2020 for energy. Over in Europe, the multiples are way higher than that. In China, the multiples are up. So we're seeing this happen worldwide, and yet everybody continues to go down this clean energy road without a really good plan on how to get there. Anyway, this is not a lecture on how to get there, but it's really important to understand that if we don't allow reinvestment in crude oil and we try to switch the world too fast, we've got a problem. And BlackRock, who said they weren't going to invest in fossil fuels anymore and runs $10 trillion, has quickly changed their mind and said, you can't transition this fast out of this, or we're going to lose the lifestyle to which most people are coming, have lived in. And if that's the case, that's going to create a lot of social impact. So we'll see how that plays out. But I think the bigger goal here is try to have a plan for how you're going to trade this. And it's pretty critical, in my opinion, that we don't assume this year will be a lot like 2020 2021. And the main reason I say that is the effervescence that we had in 2021 where SPACs came out, cryptocurrencies soared, all of this kind of stuff, NFTs, non-fungible tokens, and different currencies. This whole area leads to a point where we're sitting here with what I would call an abundance of money, throwing it at different stuff. And when the world is, I don't want to use the word easy, but when the world is opulent like that, and they're, literally trying to find something to buy that will get better returns or outperform typical markets, I feel like we're at the dangerous end of a bubble. And maybe cryptocurrencies work out and become a really big thing in the future. The real question is how that works out. For me, I think it just on a broad macro brush level, we have all of these points that are or directional arrows that are telling us we're in a level of oddity in the markets where people are not careful at all. And we had a lot of people lose money on SPACs. We still will have a lot of people get hurt by technology rolling over and rolling down, and the optimism, we're so used to things being just continuing to go up regardless of the value. It's a really crazy supply dynamic. And what I heard the other day was we still have 75 companies on the S&P 500 out of 500, like 15% of the companies there that have a price to sales ratio over 10. What does that mean? That means that if they had no expenses, if they had no employees to pay for, they had no buildings to pay for, they had no travel costs, they had no taxes, they had no research and development, if they had nothing, they were just making money, it would take 10 years for the shareholders, at least 10 years for the shareholders to get their money back at the current sales level. Now, we all know these companies have stuff underneath. But the bigger issue is that the future lookout, and Peloton's a great example where we all, Peloton runs up in price and runs, and all of a sudden rolls over the top and then goes all the way back down, and all of that money is lost. Well, we have 75 companies that would take 10 years to get back if they had no cost structure within their company. So we still have lots of flamboyance in terms of valuation, and yet people are just looking right past that. So oil stocks are breaking out to new highs, and there was a recent Twitter chatter. Twitter has a thing called Spaces where you can kind of have an online Zoom meeting, and in this Twitter Spaces, there was one going on at one time, and it was 290 people or something watching, and it was talking about oil stocks. And there was another one with crypto, and it had 5,000. So it had like 20 times the interest, even though crypto's gone from, Bitcoin, I think was 65,000, and it's gone down to around 40. And you've got these oil companies breaking out to new 7-year highs, and nobody even shows up for the meeting. So just a really odd situation where we're going through here. So I want to talk about that a lot. So anyway, that was quite a preamble, but it's really important to set the stage. If anything we talk about here, if I can help you at all with it, I think it's going to be a very challenging year, and you're going to need to pick your entries into the market to try and make really good returns. So feel free to head over to gregschnell.com and take a look at our annual membership. It's roughly $15 a week or something like that. But we try to set you up with understanding the backdrop of the markets, and then from there, hopefully, you'll be able to take it and go forward. So commodities are doing really, really well. We're going to cover off some of the breadth in the market. The reason I want to cover this off a little bit is I want to point out two things. So I want to show you, first of all, how weak things are. So here's the Nasdaq advanced decline line. And you can see back in 2020, we had roughly a 4 or 5 month decline. and the stock market dropped about 20% in that period. We've been declining since February here, and we're only pulled back, let's say, 8%. That change in behavior is pretty significant. And so we're breaking these big uptrend lines that have been going on for almost a year and a half. And as we break down here, we don't know where the market finds a level of value that they're willing to buy, but typically the market will surge down and then it'll have a reflective bounce back up. And then on that reflective bounce back up, we'll find out if we've got energy to go to new highs or if we actually start to make lower highs and go lower again. And as I mentioned, we still have plenty of optimism or hope-timism in the market where people think unending levels of growth are coming to all of these wonderful companies coming out. So all of that makes me really dig in and try and watch the work even more closely and be less assumptive that the market is going to be able to race higher. So we have this big downtrend in here, and what we've got now is obviously this big area, and we've pushed down quite hard here recently. But look at just taking a 2-week moving average of the advanced decline lines. We're in like really, really difficult area here where we have lots of stocks underperforming, and they're going down. And we haven't had anything really going on since middle of November to speak of. And yet, the market isn't very far off its highs, which would say it's resilient. But on the other hand, I think it also takes time for people to just start getting tired of going back in and bidding in a market trending down, and they just get exhausted. So here's the stocks making new highs and new lows on the Nasdaq. And so what we call that is the net new highs. And what we've seen is since November, the Nasdaq consistently is making more new lows than highs. And the way that shows on this chart down here is at the zero line here, we can't get above it. And so I've written in here back in November, December that this still needs caution. And when you're in a big bull market, you're running up. And then since February, we've kind of knocked this down, and we still had some, and it was okay. And then we had this final surge heading into November, and then literally it collapsed out of there. But look at how weak this is compared to anything we've seen in 7 years. Now let me unwind this tape for you. And when we take this data all the way back to before the 2000 market top, we saw a market that had similar behavior, but it actually went on for like a year, almost with a couple of months where we were literally had a few new highs compared to new lows. And it was quite difficult, and so we're getting, this is a pretty thick black area that's been hanging around for a while, and we're barely off the high. So what if this is a change in tone? What if we're actually going to start to recognize that this was a period like 2000, and we have a lot of unwinding to do? I'm not forecasting that. I'm just, as I pointed out in my end of the year special on StockCharts, the most influential charts in 2021, I mentioned that there was a huge volume spike on the Nasdaq. So we're sitting here with very uncomfortable data telling us to be extremely cautious, and yet I know still lots of people want to get long and are trying to buy every dip. And we get trained that way to do that, right? So here's the New York advanced decline line, and it's just starting to break down. So it's been a little more stable than the Nasdaq one. It doesn't have that big downslope where I had all those red dashes. We can see that the uptrend line, we kind of got below it, and then we've been trying to rally back above it, and we call this a back test. And when it doesn't make it back through there, that can be a problem. So we don't have the same level of weakness in the advanced decline line on the New York Stock Exchange, but a lot of the SPACs that were listed and a lot of the technology names that are down hard are listed on the the Nasdaq. So we do have this bifurcated market where it's split barbell approach, some stuff on one end and some stuff on the other end, and not much in the middle. You're kind of winning or losing, but you're not staying flat. So it makes it very difficult. I thought I turned off all my notifications. Sorry about that. It makes it very difficult for us to make real money here. And so the point I want to make is don't let this drag down your portfolio value and be afraid to just take smaller positions or no positions. And when your positions start to weaken, regardless of your optimism or optimism, let them kick you out of your trade and eventually get back into it. There's no harm in capturing profit. And here's the New York stock market for the new highs and new lows. And you can see for 2018, this thing could barely get above I've got this line set. I think I manually put it in, but it's roughly at 100. And you can see all the way through 2018, for almost a full year, this thing could barely get above 100. Well, here we're sitting here since November, we've barely gotten above 100. All through 2020, there was a reason here because we had this big sell-off where everything fell, so nothing's making a new high yet. It's not making a new low either, but it's not making a new high. So the line looks weak coming out of a big dip. But my point would be is after the big run and all of a sudden we're now starting to live on this weaker side, be aware of how different that is. Okay. When we go to the S&P 1500, which is a bigger picture, the advanced decline data is still holding up. For some reason, that didn't update. Let me just see. That might not update until tonight, I guess, later tonight. I'm recording this on the evening of Tuesday. But we're seeing this upsloping trend line breakdown today. And now what we're looking here, or breakdown last week, and now what we're looking here is, will this advanced decline line hold up or will we start to drop again? So the top 1,500 stocks have been okay, but not great. Okay, I want to show a couple of things, why I created the Schnell strength indexes, and the reason, one of the biggest things about the way to use them is just kind of the background information it tells you. So from May, June, August, July, August, September, we had an uptrending market, but with very little power. And so I think we all talked about how the leaders were carrying things, but the market was weak behind the scenes. The bigger picture that we have now is we've had a couple of sudden run-ups, but haven't been able to hold up there. And so it changes us. And for me, what I want to try and do is buy near these lows and sell near these highs. And you can see that we're rolling down here. And as this market starts to get weaker again, that just tells us that all the industry groups and everything are getting very, very weak. And we want to be aware of the wider tone. So this is a faster indicator. But essentially what I like to look at it for is going back to the beginning of 2021, we had 1, 2, 3, 4, 5, 6, call it a wide 6, 7 buying opportunities that were really good places to kind of get involved when a lot of the stocks were starting to rise together. It's helpful to at least be able to be aware when the market is weak and turning up instead of when the market is strong and getting weaker, and yet we still assume that everything will work out okay. So the purpose of these strength indexes, and there's two different time frames. The one I just showed prior was a longer time frame, and what it said was for this rally in here, we just don't have a lot of participation, but the rally was still okay. That's the brown line in the back here. And so that was chopping around here with very low momentum. Yet in October, we had this big, beautiful run. And really, that marked the top. And now recently we got up here and I said, this is the highest we've been all year. So be careful. We could start to lose momentum. And sure enough, the tech names have sold off since the beginning of the year, whereas the commodity names have held up. And so now we might start to lose the commodity names and we might actually start to rotate everything back down to the bottom. But then what we want to do is be able to be ready when the market turns back up. And so I publish these every day for the for my clients. Now, this is a different way of measuring it, a third one. And what we see on this one is that same sort of thing, but it's when I use all three of these, it's giving us signals, but when they all start to turn up together, this can be a wonderful signal. And that's what we got in October and in early December. And these have been big rises up, and then basically you just trail your stops. And when you get kicked out, you just leave. So we do have some tools to understand when the market is actually starting to improve. Clearly, it's not starting to improve. It's been declining since the beginning of the year. Unless you were in commodities and banks and you made some money, that might be coming to an end. But in general, when people have to make margin calls or have to, they've got losses that they need to cover, they'll sell good stuff. And so that's how good stuff eventually goes on sale and people start to get out of their positions. So the purpose of these strength indexes is just to help us understand how strong or how weak the market is. And you can just see, there's been better opportunities to ride in the market by using these indicators, just helping you get your entry timing a little bit better so that you're not trying to force an entry here where the market is weak. Okay, so we have some tools to help with that. Now I want to talk specifically, I've been pounding the table on oil and gas and how they could do pretty well. And some of the charts are just literally lighting up. I think if you've seen COP or some of these stocks, this was a $70 stock at the turn of the year, and here we are up around 90. Like, these are nice moves very, very quickly, and the banks have done the same thing, or some of the banks have done the same thing. But we could use Devon Energy. One was 40 to 52, and we could use FANG. These are nice pushes. CNQ is one I've been Canada's largest. This thing's literally been lighting it up here, going from 40 to $54. Really strong price action in all of these. Now, this chart in the middle here talks about the exploration and production compared to the QQQ. And what we see here is every time we kind of get to this level, QQQ takes over and starts reasserting its strength. We're sitting here right now, and I'm wondering, do we have the power to break out? And so as we watch this is a critical time to decide whether or not energy can continue higher or if the overall market weakness will help pull it down. If that's the case, we need to be just as worried in energy about losing the profits we've just made. And perhaps it's time for a rotation back into technology names. And even if it's only for a bounce, even if it's only for 2 or 3 weeks, but you can see that when this chart turned, it was pretty good. And here is the, I'm not sure why MPC is up there. That's really odd. Here's XOP compared to the S&P 500. And what we want to see here is we want to see this start to break out meaningfully and basically show us that we've got a bigger uptrend ahead, where when XOP outperforms the S&P 500 and the Nasdaq, then that's going to attract more funds into it. Now, again, we can talk about whether or not crude oil is going to end up getting to $100 this year. I actually expect it will get to $100 this year, but we're testing this prior high right now, which makes it an important place to at least watch. Now, we have Kazakhstan, we have Russia as an issue with Ukraine, we have Iran still with sanctions on it. We have a changing belief that OPEC doesn't have the reserves that we all thought they did, and they aren't going to be able to handle the change in volume. And then we already have demand outstripping supply meaningfully. So if energy prices are going to continue high, that will also stall the economy. And if we look back in just unwinding this tape all the way back to 2003, what we see here is oil in 2007, and that was the great financial crisis starting, but oil peaked in June of that year, and it was actually raising costs of everything, and that actually also helped stall the rest of the economy. And so it's these big sudden surges that would be a problem. I think if we can get oil up in the 110 level, we're probably still just fine, because we went for years with it up at that level, and the world has moved on significantly since then. So I think we have some hope here for perhaps watching for a turn. There's some reasons. This XOP chart, we've got oil sitting right at $85, but eventually I think this thing still works higher. My strength indexes are saying things are still pulling back and getting weaker, so we need to be ready for that, and hopefully as that changes, we're on top of it. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern Time. You can also see the recordings on StockCharts TV YouTube page or StockCharts on demand. Thanks everybody. Have a good week. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.